As the US markets are closed for the weekend, we are looking at the final print for Strive Inc., trading on the NASDAQ under the ticker symbol ASST. It finished the last session on Friday, October 24, 2025, at $1.10 per share. That was a stunning move, closing up $0.24 or 27.29% on the day. Now, when most investors see a stock at $1.10 rocket up over 27% in a single day, especially on astronomical volume, the immediate assumption is that this is just another volatile, low-float penny stock. It's the kind of name that traders on the Robinhood app or using interactive brokers might jump on for a quick flip, assuming it's a pump-and-dump scheme or a momentum play with no real substance. The expectation is that it's fundamentally hollow. But with Strive Inc., that expectation could not be more wrong. The reality of what ASST is and what this move represents is one of the most complex, high-stakes, and chaotic stories on the market right now. This isn't just a random penny stock. This is the newly public, highly controversial vehicle for Strive Asset Management, a firm that has already made significant waves in the financial world, and it's currently in the middle of a massive multi-part corporate transformation. Let's establish the common ground. We are all looking for opportunity. In a market dominated by the same massive names like Apple stock or Nvidia stock, a 27% gain in a day feels like a lifeline, a chance to get in on the ground floor. The narrative you see circulating on social media is that this is the beginning, that ASST is the next big thing. But here is the challenge to that belief. This stock is not moving in a vacuum. Its recent action is the market's frantic attempt to price in a dizzying array of news that is both wildly bullish and terrifyingly bearish, all at the same time. The volatility isn't just hype, it's confusion. This company is simultaneously merging, acquiring another company, adopting a Bitcoin treasury strategy, and, most critically, filing to potentially flood the market with over 1 billion new shares. So while the expectation is a simple buy signal, the reality is a high wire act with no safety net. Let's break down this recent trading action. That 27.29% jump to $110 did not happen quietly. The stock traded hundreds of millions of shares, a truly staggering volume for a company with its market cap. This is not institutional buying. This is not Schwab Intelligent Portfolios or a Fidelity Mutual Fund building a long-term position. This is a feeding frenzy. This is what happens when a company with an enormous public profile, thanks to its founder Vivek Ramaswamy, collides with the world of low-priced stocks. Retail traders, using everything from SoFi Invest to more advanced interactive brokers platforms, are all piling in. But what are they piling into? The stocks chart has been all over the place. Just a few weeks ago, it was trading significantly higher. This 27% move is a recovery from a brutal sell-off. The market is digesting a recent prospectus filed for the resale of up to 1.28 billion shares of common stock. Let that number sink in. For a stock trading at $110, that is a potential deluge of dilution that could, in theory, send the share price collapsing under its own weight. This is the central conflict, the hype of the company's mission versus the crushing reality of its share structure. The stock is also reacting to a whirlwind of corporate maneuvers. First, Strive Asset Management, which was a private company, executed a reverse merger with a company called Asset Entities Inc., which is how it became the public company ASST. Then, almost immediately, Strive Inc. announced it was entering entering into another merger, this time an all-stock deal to acquire Semler Scientific, a healthcare tech company. On top of that, the company has publicly stated it is now the first publicly traded asset management firm to adopt a Bitcoin treasury strategy, aiming to hold Bitcoin on its balance sheet as a primary treasury asset. This is an immense amount of information for the market to absorb. Is this a coherent strategy, or is it a desperate attempt to bolt on as many hot narratives as possible, anti-ESG, healthcare tech, and Bitcoin, to attract investor interest? The 27% pop suggests the hype is winning the immediate battle, but the underlying volume and volatility show that a war is raging between the bulls and the bears. So what exactly is Strive Inc.? What does this company do? At its core, Strive is an asset management firm. It was co-founded by Vivek Ramaswamy and Anson Frericks and famously drew early backing from high-profile investors like Peter Thiel and Bill Ackman. Its entire premise, its unique selling proposition, is a direct challenge to the prevailing trend of ESG, or environmental, social, and governance investing. Strive's mission is to, as they put it, depoliticize corporate America. Their belief is that large asset managers, think BlackRock, State Street, Vanguard, have been using their immense voting power from all the shares they hold in their ETFs to push political and social agendas on companies, agendas that Strive believes are detrimental to shareholder value. Strive's solution was to launch its own suite of ETFs, funds that ordinary people can buy in their individual brokerage account. These include funds like DRLL, the Strive US Energy ETF, or SHOC, the Strive US Semiconductor ETF. The key difference is not just what they hold. In fact, their Strive 500 ETF, STRV, holds the same companies as any S&P 500 fund. It's full of Apple stock, Tesla stock, and Nvidia stock. The difference is how they use the votes associated with those shares. Strive actively votes its proxies against ESG-related shareholder proposals, against diversity quotas, against emission caps, and in favor of proposals that they believe maximize profit and excellence above all else. This is a highly controversial and politically charged mission. It has attracted a massive, dedicated following, and to date, over $2 billion in assets under management for their funds. This is the expectation side of the coin. Investors are buying ASST as a way to support this mission. They believe that if Strive can capture even a small fraction of the trillions managed by the Big Three, its own stock will be a massive winner. This is a bet on a political and cultural movement, as much as it is an investment. Now, we must turn to the reality of the financials, and this is where it gets very, very difficult. This is the part that many people doing their online investing on a slick app might miss. Because ASST was born from a reverse merger with asset entities and is now in the process of another merger, the financials are complicated and, frankly, not strong. Recent analyses point to the company being unprofitable. It has reported negative equity. The price-to-book ratio is deep in negative territory, a striking negative 9.5x according to some reports. This is not the profile of a stable blue-chip company. This is the profile of a high-risk venture. The market is not valuing ASST based on its current earnings or its book value. It is valuing it on a story, a mission, and a collection of speculative catalysts. This is why comparing Strive to, say, Fidelity Investments is an apples and oranges situation. Fidelity is a decades-old, diversified financial giant. Strive Inc. is a public startup with a political mission, which is now pivoted to also become a Bitcoin holding company and a healthcare tech owner. This makes valuing it incredibly difficult. The Bitcoin treasury strategy is a clear attempt to follow the MicroStrategy playbook, using the company as a leveraged bet on the price of Bitcoin. This will undoubtedly attract a new class of investors, but it also introduces an entirely new layer of volatility that is completely disconnected from its core asset management business. If Bitcoin drops 20%, ASST will likely drop with it, regardless of how many assets its ETFs are gathering. This complicates the thesis for anyone looking for investment help or a stable addition to their portfolio. This is pure speculation. Looking to the future, the scenarios diverge wildly. The bull case is clear. The anti-ESG movement gains even more traction, and Strive's assets under management swells from $2 billion to $20 billion, or even $100 billion. The fees from those assets would make the company extremely profitable. Simultaneously, its Bitcoin treasury strategy pays off in a bull market, and the Semler Scientific acquisition turns out to be a stroke of genius, providing a stable, profitable business line. In this scenario, 110 will look like an absurdly cheap entry point. The bulls believe the dilution risk from the 1.28 billion share filing is just a formality, a shelf registration to give the company flexibility, not a sign that they are about to dump all those shares and crater the price. The bear case is just as compelling, if not more so. The core anti